I mean, imagine losing well over 1 million paying customers in just 3 months. For most subscription-based businesses, like whether you are running a streaming service or a gym franchise or whatever, that is basically a bankruptcy notice.
Oh, absolutely. Wall Street would completely panic. The stock tanks immediately.
Right. But for UnitedHealth Group, deliberately shedding over 1 million members actually resulted in a record-breaking $111 billion quarter. And today we're going to find out exactly how they pulled that off. So, welcome to the deep dive. We are exploring the massive, complex business of the American healthcare system, and we are looking at it all through the lens of UnitedHealth Group's newly released first quarter 2026 earnings report.
Yeah, in this report, which is dated April 21, 2026, it's honestly a pretty rare document. I mean, it captures a corporate titan not just operating at peak capacity, but actively and, ruthlessly rewiring its entire architecture mid-flight.
It really is wild. And just a quick side note for you listening, compiling the data for today actually started with a literal digital roadblock. We went to pull the raw financial summaries from MarketBeat, and we just hit a wall.
Yeah, that was pretty funny.
We had to sit there and pass like a Cloudflare security verification just to prove we weren't malicious bots trying to scrape their data.
Which, the irony there is hard to miss. I mean, we had to prove we are human to a tech security firewall just to read a report detailing how a healthcare company is spending billions on tech security and artificial intelligence to essentially replace human administration.
Exactly. Okay, let's unpack this, because I want to start with the sheer staggering scale of the numbers here, because this isn't just about us reading off a spreadsheet. Our mission today is to help you understand how this machine generates $111 billion in a single quarter, and more importantly, how they are aggressively shrinking their geographical footprint to prepare for the future.
Right. And the scale really sets the stakes for the rest of the conversation.
Yeah.
I mean, for the first quarter of 2026, UHG hit $111.7 billion in revenue.
That is just a massive number.
It is. It's a 2% year-over-year growth. They brought in adjusted earnings of $7.23 per share.
Sure.
And they are performing so confidently right now that they actually raised their full-year earnings outlook to greater than $18.25 per share.
Just to put that $111 billion in perspective for you, that is revenue generated in just 90 days. I mean, that is more than the annual gross domestic product of many entire countries.
Yeah.
But the money is just the output, right? I want to look at the engine generating that money because the report details some incredibly bold strategic initiatives that they started late last year. First off, they are completely exiting their non-U.S. businesses.
Right. They're pulling out of their remaining South American operations.
Yeah. And second, they have refreshed nearly half of their top 100 leadership roles.
And what's fascinating here is that this is not a company in distress.
Which is usually when you see that kind of turnover.
Yes, exactly. Usually when a global corporation sheds international divisions and turns over like 50% of its top executive suite, it is a desperate, flailing attempt to stop bleeding cash. But UHG generated $8.9 billion in cash flow from operations this quarter alone. I mean, they are highly profitable.
So why clean house? I mean, it's like taking a massive cruise ship that is already breaking speed records, kicking half the senior officers off the bridge, and then announcing you are only sailing in domestic waters from now on.
Right. It seems nuts. But it's because the skill set required to manage a decentralized, sprawling global insurance company is entirely different from the skill set required to build an automated, vertically integrated domestic health tech monopoly. They are voluntarily shrinking their global footprint to consolidate power in the United States. They basically want their capital and their executive brainpower entirely focused on dominating the American market.
And you can actually see the financial friction of this massive pivot in their operational numbers. Like, if we move from their grand strategy down into the actual costs of running the business, there are two distinct metrics moving in completely opposite directions here. First, you have the medical cost ratio, which actually fell to 83.9%.
Yeah, that is a 90 basis point drop from the first quarter of last year. And for those who don't know, the medical cost ratio is simply the percentage of premium dollars the company spends on actual patient care. So the lower the number, the more of your premium dollar they're keeping.
Right. And the report attributes this drop to two things: strong medical cost management and, quote, favorable reserve development. Hold on, reserve development, because that sounds like a banking term to me, not something that has to do with medicine.
Well, you're right. It essentially is a banking term just applied to insurance. So insurance companies are required to hold massive pools of cash reserves to pay for expected future medical claims. But what happens if patients end up utilizing fewer services than expected? Or, if the claims come in cheaper than the actuaries predicted?
Oh, I see. That cash pool suddenly has too much money in it.
Exactly. The company realizes they over-reserved, so they just release those funds. That is favorable reserve development. And that cash drops directly, instantly to their bottom line as profit. It makes their medical cost management look incredibly efficient.
Okay, that makes sense. But then we look at the second metric here, the operating cost ratio. And this is the cost of actually running the business, right? So salaries, administrative buildings, computers, all of that.
Right.
While the medical costs went down, the operating cost ratio went up to 13.8% compared to 12.4% last year. Now, if they are shedding international divisions and simplifying their focus, like we just talked about, shouldn't their operational costs be plummeting? Where is all this bloat coming from?
Well, it isn't bloat. It is an investment tax.
What do you mean?
They're intentionally suppressing their own short-term operational margins to fund a massive infrastructure build-out. The report explicitly highlights substantial new investments in artificial intelligence, cybersecurity, and advancing interoperability.
Okay, interoperability is one of those words that gets thrown around in tech a lot. But for an actual healthcare consumer, what does UHG spending billions on interoperability actually look like?
Well, think about the last time you went to a new specialist. You probably had to carry physical paperwork or verbally recount your entire medical history all over again.
Oh, yeah, every single time.
Right, because your primary care doctor's computer system couldn't talk to the specialist computer system, and neither of them could talk to your insurance provider seamlessly.
It is a notoriously fragmented system.
Exactly. So UHG is spending massive capital to build the digital pipes that connect all that fragmented data. But they aren't just doing it to save you time in the waiting room. They are building a system where AI can handle prior authorization.
Oh, wow. Prior authorization is the absolute bane of everyone's existence. I mean, it's when your doctor prescribes a treatment, but you have to wait days or even weeks for the insurance company to manually review the file and approve paying for it.
Right. Now imagine an AI system that has instant interoperable access to your entire medical history, the doctor's notes, and the insurance policy guidelines.
Yeah.
The AI can process that authorization in milliseconds.
That's crazy.
So UHG is taking a hit on their operating costs today so they can eliminate tens of thousands of human administrative jobs tomorrow. They are basically transitioning from a healthcare service company to a healthcare technology platform.
Wow. And here's where it gets really interesting because you can see this tech-first strategy playing out in real time with what they're buying and selling. During this exact same quarter, they entered an agreement to acquire Allegis Technologies.
Yeah, and Allegis operates in a very specific niche. They provide the financial technology platform that manages consumer-directed healthcare accounts. So we are talking about flexible spending accounts, FSAs, and health savings accounts, HSAs.
Okay, so they aren't buying like a hospital network. They are buying the digital wallet that patients use to pay for their out-of-pocket care.
Exactly. And it is a brilliant play on where the market is going. As insurance premiums rise, more employers are shifting their workers onto high-deductible health plans.
Right, to save money on the premium.
Yeah. And when you have a high deductible, you are suddenly spending a lot more of your own money out of pocket before the insurance even kicks in. To manage that, consumer use of HSAs is absolutely skyrocketing. So by acquiring Allegis, UHG now owns the very financial plumbing where all those out-of-pocket consumer dollars flow.
And to fund that domestic tech acquisition, they are finalizing the sale of their international assets. Like the report confirms they completed the sale of their Optum UK business. They even committed $400 million of the net proceeds from that UK sale straight into the UnitedHealth Foundation.
Which is really smart because that accomplishes multiple goals simultaneously. I mean, they offload a non-core foreign asset, they generate capital, and they funnel $400 million of it into a massive philanthropic injection.
Right.
It builds immediate domestic goodwill and aligns perfectly with the mandate of their newly formed Public Responsibility Committee.
To really understand how all these pieces fit together, though, the AI, the medical costs, the financial tech second arch, we need to look at the structural foundation of the company itself. Because most of us just think of the name on our insurance card, but UnitedHealth Group is actually a two-sided coin. You have UnitedHealthcare and you have Optum.
Yeah, and the dynamic between those two halves is really what makes UHG such an unstoppable force in the market. It is vertical integration on a scale that is just hard to comprehend.
So let's break down the two sides for you. On one side, you have UnitedHealthcare. This is the payer. They provide the actual insurance benefits to individuals, employers, and government programs like Medicare. For the first quarter, UnitedHealthcare brought in $86.3 billion, and their operating margins actually expanded to 6.6%.
Right, so think of UnitedHealthcare as the toll booth. They collect the premiums, they control who gets access to the system and under what financial terms.
Then, on the other side of the coin, you have Optum. This is the provider side. Optum is the actual highway system. They deliver medical care, they manage pharmacy benefits, and they run the data analytics. Optum served over 122 million consumers this quarter, driving $63.7 billion in revenue. And Optum itself has basically 3 lanes on that highway.
Yeah, you have Optum Health, which employs the doctors and runs the clinics, bringing in $24.1 billion.
Right.
Then you have Optum Insight, the data and consulting arm, which generated $5.1 billion. And then you have Optum Rx, the massive pharmacy benefit manager.
Now, here's where I have to push back a little, or at least point out a pretty massive contradiction in the numbers here.
Okay.
Optum Rx brought in $35.7 billion in revenue this quarter. That is a 2% increase from last year. But their earnings from operations actually jumped from $1.3 billion down to $1.2 billion. And even crazier, their adjusted scripts, so the actual number of prescriptions they filled, fell off a cliff.
They really did.
They went from filling 408 million prescriptions last year to just 383 million this quarter. So how does a pharmacy business make more top-line revenue while filling 25 million fewer prescriptions and still suffer a drop in actual earnings?
It's a great question. And if we connect this to the bigger picture, it reveals the absolute symbiosis and the inherent vulnerability of their vertical integration. The report explicitly links the drop in prescription volume at Optum Rx to membership attrition over at UnitedHealthcare.
Oh, so fewer people walking through the UnitedHealthcare toll booth means fewer cars driving on the Optum Rx highway?
Precisely. The people who lost their UnitedHealthcare insurance were the exact same people getting their generic blood pressure medication filled through Optum Rx. The volume just collapsed.
But wait, how did the revenue still go up 2% then?
Because of specialty pharmacy. Optum Rx is filling fewer cheap everyday prescriptions, but they're filling more incredibly expensive specialty drugs. So the top-line revenue number stays inflated, but because they lost the massive volume of those everyday members, their actual operational earnings shrank.
Wow.
It shows that even a behemoth like UHG can't isolate one side of its business from the other. A diet on the insurance side means the pharmacy side starves.
Which brings us to the ultimate paradox of this entire earnings report. We started this deep dive by talking about losing 1 million customers. Let's look at the exact numbers of that attrition because it is staggering.
It really is.
Total people served by UnitedHealthcare fell to 49.1 million. They lost 965,000 seniors in their Medicare Advantage and complex Medicaid programs. And on top of that, they lost another 220,000 members in their community and state segment, which is traditional Medicaid, due to states changing their eligibility rules.
Yeah, so we are looking at well over 1 million people, largely seniors and lower-income individuals, who are no longer on UHG's rolls compared to previous highs.
Right, and if you are sitting there listening to this, you might be wondering how on earth the company loses over 1 million paying members in its Medicare and retirement division, and yet that specific division's revenue still grew 1% year over year. I mean, overall operating margins expanded, they lost the volume, but somehow gained the profit.
They achieved this through a mechanism the report refers to as trend-driven repricing actions.
Trend-driven repricing actions. I mean, that sounds incredibly clinical. Explain the mechanism there. How does a massive insurer actually enforce a repricing action?
Well, they look at the medical cost trend, basically how much hospitals and drug companies are raising their prices. If UHG sees that care is going to cost 5% more next year, they use their sheer market dominance to force a new reality.
Oh, so?
They go to an employer and say, your premiums are going up 7%, or they go to a hospital network and say, we are cutting our reimbursement rates to you. They simply adjust the financial levers to guarantee their profit margin remains completely insulated from the rising cost of care.
And they applied this to the members they kept. But they didn't just raise prices, they actively changed the types of members they're recruiting, right?
Yes. The report notes significant growth in their commercial fee-based employer offerings. They added 415,000 members in this category.
Okay, for those not living in the insurance world, what is the difference between a traditional member and a fee-based member?
In a traditional fully insured model, UHG collects a premium and takes on all the financial risk. So if the patient gets cancer, UHG pays the massive hospital bills. But in a commercial fee-based model, the employer takes on the risk.
Oh, I see.
Yeah, the employer pays the medical bills out of their own corporate funds. They just pay UHG a guaranteed flat administrative fee to use the Optum network and process the paperwork.
Ah. So UHG takes zero medical risk, but guarantees themselves a steady administrative profit.
It is the ultimate safe bet. So look at the grand swap they pulled off this quarter. They lost over 1 million government-sponsored Medicare and Medicaid members, populations that are complex, highly regulated, and honestly often run on razor-thin margins.
All right.
In exchange, they grew their commercial fee-based business, where they take zero risk and collect guaranteed fees, all while aggressively raising premiums on everyone else.
So they are entirely willing to let their total membership numbers shrink if it means the ecosystem they curate is intensely profitable. I mean, they're not trying to cover everyone. They are trying to cover the right margins.
Exactly, which is an incredibly effective corporate strategy. I mean, it's why they generated over $111 billion.
So what does this all mean? When we zoom out and look at the entirety of this Q1 2026 report, what should you take away from all this? United Health Group is executing a masterclass in structural transformation. They are shedding the distractions of international markets. They are turning over their executive leadership to bring in tech-focused visionaries. They are deliberately absorbing a short-term hit to their operating costs to fund a massive AI and interoperability infrastructure that will, frankly, eventually eliminate human administrative jobs.
Hmm.
And they are perfectly content to lose over 1 million members if they can use their pricing power to extract even more profit from the members they keep.
Yeah, they are building an automated, highly profitable fortress around the American healthcare consumer. But analyzing the mechanisms of this report raises an inescapable question regarding the broader system.
Let's hear it.
Well, the company clearly noted that underlying medical cost trends remain consistently elevated. Healthcare is getting significantly more expensive. And UHG's response to that reality is to exercise its pricing power, raising premiums and shifting toward risk-free, fee-based employer contracts, while comfortably shedding over 1 million complex Medicare and Medicaid patients to protect its margins.
Right, they just insulate themselves from the inflation.
Exactly. But if the most powerful, well-resourced player in the market is relying on this margin-first strategy, what happens to the market for the patients who fall outside those margins? I mean, from a purely economic standpoint, does a system dominated by this dynamic inevitably segment into a high-margin AI-driven utopia for commercial populations and an underfunded, shrinking reality for the vulnerable populations left behind?
That is the big question, isn't it? If the biggest ship in the ocean decides to only sail in the most profitable waters, everyone else just has to figure out how to swim. Thank you all for taking this deep dive with us today. Keep questioning the mechanisms behind the numbers, and we will see you next time.